This is your Swap Hunt Daily News for February 24th, 2026. Jane Street is facing a federal lawsuit over alleged insider trading during the collapse of the Terra ecosystem, and Bitcoin's demand signal has gone negative for a record 40 consecutive days. Markets are holding in deeply bearish territory today, with sentiment sitting at extreme fear, one of the lowest readings on record. The total crypto market cap is essentially flat over the past 24 hours, masking persistent weakness beneath the surface. Bitcoin briefly dropped into critical support territory before clawing back ground. Altcoins continue to underperform across the board. Corporate selling is now extended to a record streak with no buying activity logged, and fund outflows remain the dominant institutional signal. It's a fragile environment with sellers still in control. Terraform Labs' bankruptcy administrator has filed a federal lawsuit against Jane Street, one of Wall Street's most prominent trading firms, alleging insider trading tied to the catastrophic May 2022 collapse of the Terra ecosystem. The case centers on allegations that Jane Street obtained material non-public information through a former Terraform intern who later joined the firm. According to the complaint, that individual maintained a private back channel with Terraform's head of research, passing along sensitive operational details that would never have been available to outside market participants. The most striking allegation involves the Curve Finance liquidity pool. Just before the Terra USD depeg became public knowledge, Terraform quietly removed a substantial sum from the pool. Within minutes, a wallet linked to Jane Street allegedly withdrew another large block from the same pool. The administrator argues this sequence allowed Jane Street to unwind exposure and position trades ahead of the panic that followed. The complaint goes further, claiming these actions directly intensified the liquidity stress that contributed to the ecosystem's rapid collapse, erasing tens of billions in market value within days. Jane Street has strongly denied the accusations, calling the lawsuit baseless. But the implications reach well beyond one trading firm. If the allegations hold up in court, this case could set a significant precedent for how proprietary traders interact with crypto projects and handle non-public information. Regulators have been pushing for exactly this kind of accountability in digital asset markets, and a successful suit could reshape the compliance landscape for institutional players across the board. Bitcoin's U.S. demand signal has now been in negative territory for 40 consecutive days, the longest such streak on record. The indicator last flashed positive on January 15th, and despite a brief attempted recovery in early February, it failed to hold. According to analysis from CoinDesk, the failure to recover after that rebound suggests this is not a temporary pause in demand. It points to something more structural. U.S. buyers, who have historically driven significant price momentum during bull phases, appear to have stepped back in a meaningful way. This matters for the broader market narrative because U.S. institutional demand has been one of the key pillars supporting Bitcoin's rally from its 2024 lows through the peak of 2025. When that pillar erodes, the market loses one of its most reliable sources of sustained buying pressure. Corporate treasury activity has also turned negative, with Coin Bureau data showing 3 consecutive weeks of selling by large corporate holders, the longest such streak since companies began accumulating Bitcoin in 2020. CoinShares fund flow data adds further context, showing significant outflows from digital asset funds in the most recent weekly report. Taken together, the picture is one of institutional disengagement rather than a simple price correction. Whether this represents a cyclical reset or something more prolonged is the central question for market participants heading into March. The Federal Reserve has proposed a significant rule change that would remove so-called reputation risk as a factor in its bank oversight framework. If finalized, the rule would also bar Fed supervisors from pressuring banks to cut ties with disfavored industries, including crypto. This is a direct response to what the industry has long called Operation Chokepoint 2.0, a pattern of informal regulatory pressure that effectively pushed banks away from crypto clients without formal rules or due process. For years, crypto companies have struggled to maintain basic banking relationships, facing account closures and service denials that were rarely explained in writing. The proposed change would mean that banks could no longer be penalized simply for the perceived reputational risk of serving a crypto firm. That's a meaningful shift. Access to banking infrastructure is foundational for any serious crypto business, particularly exchanges, custodians, and stablecoin issuers that need to move large dollar amounts through the traditional system. The proposal is still in the public comment phase, so it is not yet final. But the direction is clear. Under the current administration, the regulatory posture toward crypto is shifting from cautious restriction toward active accommodation. For exchanges like Binance US, which reportedly lost significant banking access following its SEC lawsuit, a rule like this could meaningfully improve their ability to rebuild domestic operations. Meta Platforms is reportedly planning to re-enter the digital payment space through stablecoins, with a potential rollout across Instagram, WhatsApp, and Facebook targeted for the second half of this year. According to market intelligence outlet Milk Road, Meta has issued a request for product to outside firms capable of supporting stablecoin payment infrastructure. The company is not looking to build its own stablecoin this time. That's a notable distinction from its previous attempt. In 2019, Meta unveiled Libra, a proposed global digital currency that drew immediate and overwhelming regulatory backlash. Congress called Mark Zuckerberg to testify. The project was later rebranded as Diem before being shut down entirely in 2022. This time the approach is different. Rather than creating a new token, Meta is reportedly seeking third-party partners with existing stablecoin infrastructure. Stripe has emerged as a leading candidate, having acquired stablecoin infrastructure platform Bridge in late 2024. Stripe's CEO Patrick Collison also joined Meta's board earlier in 2025, creating a direct institutional link between the two companies. The scale here is hard to overstate. Meta's platforms reach more than 3 billion users globally. If stablecoin payments are embedded into that ecosystem, even a fraction of that user base transacting on-chain would represent a transformational volume event for stablecoin adoption. Regulators will be watching closely, but the commercial logic is compelling. The Securities and Exchange Commission has approved WisdomTree's plan to offer 24-hour, 7-day trading and settlement for its tokenized Treasury money market fund. It's a first for the United States, and it adds meaningful institutional momentum to a tokenized asset market that has already grown to roughly $10 billion, led by players like BlackRock and Circle. The approval gives WisdomTree the regulatory green light to operate a tokenized fund entirely within a U.S. compliance framework without the workarounds and jurisdictional patchwork that earlier tokenization projects had to navigate. For the broader market, the significance here is structural. Traditional money market funds settle on a T+1 or T+2 cycle, meaning investors wait days to access proceeds. A tokenized version that settles around the clock changes the liquidity profile entirely, making these instruments far more useful as collateral and as a parking spot for capital that needs to move quickly. This approval also arrives alongside the New York Stock Exchange's publicly stated interest in exploring on-chain settlement systems and Kraken's launch of 24/7 perpetual trading for tokenized U.S. stocks. A pattern is emerging. Traditional financial infrastructure is moving on-chain, and regulators are beginning to accommodate it. Canton Network's cross-border tokenization of institutional repo markets adds to that narrative, with the firm targeting access to hundreds of trillions in previously illiquid assets. Step Finance, a Solana-based portfolio management and DeFi protocol, has announced it is shutting down operations following a $27 million hack in January. The team is working on a buyback plan for holders of the native Step token based on a snapshot of holdings and asset values taken prior to the incident. The closure marks another chapter in a difficult period for DeFi security. Step Finance was not a fringe project. It had established itself as a legitimate Solana ecosystem participant, offering portfolio tracking and yield opportunities to a meaningful user base. The loss of $27 million in a single exploit was significant enough to make continued operation unviable. What makes this type of incident particularly damaging for the broader space is the compounding effect. Each high-profile DeFi hack reinforces the perception that smart contract risk remains underpriced and that retail participants are bearing the consequences. The team's decision to pursue a buyback for pre-hack token holders shows an attempt at responsible wind-down, but it does little to address the lost funds or rebuild confidence in the protocol. For Solana's DeFi ecosystem specifically, this comes at a sensitive moment. The network has attracted significant developer attention and retail capital, but sustained security incidents threaten to undermine the narrative of a mature, production-ready environment. Regulators and institutional players will be watching how the space handles this kind of failure. That's your daily crypto roundup for February 24th. If this helped you stay on top of the market, subscribe to Swap Hunt HQ here on YouTube and follow Swap Hunt on X for real-time market alerts. See you tomorrow.